If you're not able to hedge, you need to exit the trade with a stop loss, either manually or using an automatic stop order. Don't let your trades run more than 1 to 2 to 3% against you before you trigger the stop loss or the hedge. If you're going to stop your trade out or hedge your trade, do it sooner rather than later. How can I manage risk to prevent significant losses? Once again, this is a really difficult question because risk and losses and emotions and psychology are all part of the same package. Once you start piling up higher risk trades and you start to stand to lose more money, you will then tend to get more stressed, more anxious, make the worst decisions, and for example, like removing your stop loss or adding on to a losing trade when it's clearly going the wrong way, and basically ending up blowing your account. So the question was, how do I manage risk? And it's pretty simple. Once you've reached a certain level on your chart or in your trading account where you know that you're wrong or that your risk is too high and it's putting you in an emotional state, then you should get out of that trade. The easiest way to get out of a trade is simply press the button and exit the trade and take your loss. You could put an automatic stop loss in your trade. Of course, many traders do that. You could use a trailing stop loss. If you don't know what that is, you can go and look that up on, let's say, investopedia.com. Good free resource. Or you could simply hedge your position by placing an equal, maybe not even equal, but a similar order in the opposite direction and keep your original trade open. You can't always hedge in certain countries like the US and Canada, I believe, and perhaps the UK, I'm not too sure. But if you're not able to hedge, you need to exit the trade with a stop loss, either manually or using an automatic stop order. And it's as simple as that, really. Don't let your trades run more than 1 to 2 to 3% against you before you trigger the stop loss or the hedge. If you're going to stop your trade out or hedge your trade, do it sooner rather than later. It's always very tempting to move it a little bit further. So if you're selling and the market's going up, it's very tempting to move your stop loss or your hedge level slightly higher every time the market sort of peeps up. The market will often just peep up and drop back down again, tempting you to just adjust your stop loss or your hedge level. Then it might just peep up on the next candle and drop back down again. And you might be tempted then to move your stop loss to the next peep up, and so on and so on. And before you know it, you've ended up adjusting your stop loss 10 times, and all of those peeps have taken you 5%, 10% away from your original entry level in terms of drawdowns. So to manage risk, really a very simple answer is don't take trade sizes that are too big. Don't over leverage. I don't use leverage as a general rule myself, but if you're day trading, you might want to use leverage. But if you are leveraged and you've got a position on, don't take a position that's going to kill you if the market moves a few dollars against you one way or the other. Take a position size that you can manage, and that when you need to get out of the trade, your drawdown's no more than a few percent. That's the ideal situation to be in. Don't take trades that are too big. Don't add to losing trades when the market's still going against you, unless you have a specific plan for that. Don't adjust your stop or your hedge repeatedly until you find out you're 10, 15, 20, 30% down on your account. And just keep a tight hold on it. And the very, very simple start to this whole question is, when you get into a trade, don't use too much of your account. Use a reasonable position size. Don't over leverage.